Hello everybody, welcome back. This is episode number 18 of the Trading Bootcamp series, and in this episode we will be diving into what is the standard deviation. Standard deviation is a thing that I use to see my targets, to target my everything, and to at least know the general price direction. We will look at what it is, how do we use it, and finally at the end, how do we combine it with the Power 3, as well as I'm going to be showing you guys an example just for you guys can see how strong the standard deviation actually is. But before we actually dive into this, you will have to know that the standard deviation is just a Fibonacci. So let me actually show you guys. So you can see right here, you got all of these drawings, and this is called the Fib retracement. You can see it above. Fib retracement is basically the Fibonacci. Fibonacci, if you don't know who that guy is, was basically an Italian guy. I believe it was an artist, and it has that little curve, that I believe is the golden spiral of life, or whatever the hell that is. And it's basically how life is actually not made, but how like the general structure of life is made and is based on that curve, if I'm not mistaken. And then that term got infiltrated into trading, and then you got all of these levels. Therefore, before we go into this standard deviation, I just want to explain you a little bit about the Fib and how you use it. So the Fib, ignore these above because that is the standard deviation, which where we will just be looking into the 1 and the 0, you can see. So the 0 and the 1, this is a range that you mark, for example, between a candle's low and a high, or between a candle's high and the low, and then you mark out that range from 1 to 0 or from 0 to 1. And you can see these 4 numbers right here, and these 4 numbers are basically a retracement. So let's see. So you got the 1 and a 0, and the 0.5 is called a discount or a premium. So price, imagine you got this marked out like this, right? Usually price, before it takes off, because you want to be trading in this direction, right? Before price takes off, it usually goes into a discount. The discount is that 0.5 or 50% of the range, and that is why it's very important as well. This is upside down actually, because I'll explain you why. But basically the 0.5, it doesn't matter if it's upside down, because it's always going to be the half range, which the half range is what I use the most, because if price is overbought or oversold, it needs to dive into a premium. If it's oversold, it needs to dive into a premium so that investors can sell higher, which makes more return. Logical. Whereas if price is overbought, if there is a lot of buyers in the market, it usually needs to figure itself out, and it usually needs to retrace itself back to the 0.5 or the discount or of the move, so that buyers can buy low and then sell high to make profit. Now let's see why this is upside down. So let me actually do it like this. Like this. Yeah, so it's a little bit easier because we're looking from bottom to up. This is a bullish example. So you start off from the 1 and the 0, and you're basically like this, right? Now price, yeah, every time it does manipulate to the 0.5, but most of the times it's not going to just manipulate to the 0.5. Because look, if I enter a position right here, and this is just an example, because I mean, you're not going to see much of a difference, but once you're actually trading with it, you will see a big difference. So for example, if I set limits at a discount, so I wait for price to come back and then impulse back up, right? As logical, I'm going to get a 1 to 1.49, right? But now, what if I go into this one? You can see 1 to 3, it's even more. And that's why I got all of these 3 levels. So let's start off with the 0.62. The 0.62 is the most commonly accepted and most commonly traded level. This is basically, these 3 are areas, these 3 are ranges of the discount. In this example, since price is like this, right? These 3 are areas of the discount that are inside the discount. And what price usually does is that it usually targets, it usually manipulates beyond the 0.5 and onto these two specifically, onto the 0.62 and onto the 0.705. But now the 0.62 is the most commonly accepted just because of how frequent it actually is. Because if you go check, most of the times there's a high probability that when this manipulation occurs, it's usually just going to tap that 0.61 and then go back up, right? That 0.62 and then go back up. This is called a Fibonacci level. This is one of the levels of the spiral, if you want to take that as an example. So you got the little spiral, right? Blah blah blah. And then you got like levels, and for example, this one is a 0.5, just an example that you don't have to take word for it. But now, why do I have this one outlined with yellow and not this one? Just because since I trade the power 3, my manipulations, when I take a trade, I usually like to set limits at this one, just because I'm more commonly used to it. But if I'm feeling a little bit riskier, if I feel that I know this trade, if I know that this trade is going places that price wants to get into a deep discount, this is the best area for it to tap in. Because if you see, it is basically the middle of the middle. So you got the 0 and the 1, and then you got the 0.5, and then in here you got it's very close to the middle of the discount range itself, which is really good because price most of the times does not tap into a discount of the discount, which would be everything below. Now the 0.79, it's in red just because this is a safety zone. What do I mean by this? When price usually closes below the 0.79, it usually means that price is not going to be respecting this Fibonacci. And if it's not going to be respecting, it is just going to maybe manipulate into a premium and then just sell off, right? And that's why I got these three levels. So you got, in recap, you got the 1 and the 0, the range. You got the 0.5, which is either the premium or the discount. You got the 0.62, which is an entry level that is used by a lot of traders. You got the 0.705, which is the entry level that I use and that I love most. And then you got the 0.79, which is the safety level. All right, with that said about the Fibonacci, let's go back into the standard deviation. We'll dive into this in a short minute. But let's now see the standard deviation, what it is. Standard deviation, as I said, is just the fib level. But now, instead of just being this range, you actually have all of these ranges, as you can see. Now, why is it really important? Because the standard deviation is not really a entry type. So what do I mean by this? You usually, when you put the standard deviation, it usually is about targets. I just have these 4 levels right here because these are the main components, the main levels that I trade with it. And like I don't have that many drawings, I don't have to have a drawing of the regular Fibonacci and then the standard deviation. I just like to have them both combined. But just keep in mind that the standard deviation is mostly, and it's always been used for targets. And now, how do we use it? So first off, let me actually show you the settings of the standard deviation. These are the settings that you should have of the standard deviation. So wait, let me actually copy this one and I'll put it right there. And then I can copy. So you guys can see a little bit better as well. So I can take this out and put a blue one. All right, now let's see again if it fits in one image. Wait. All right, perfect. So these are every single level that you need to know. The 0, the 1, which the 1 where it is the 1 right here. Then you got the 6.2, 7.05, 7.9, and then you got the -1, -2, 4, -4, -2.5, 2, 1, 2, 5. Yeah, just focus on the negative. If you guys don't want to pass the positives, it's okay. Focus on these negative, and I'll show you guys why in a minute. So let me yeah, you guys can have a little bit of time to screenshot this, right? And now let's see, how do we use it? So let's go straight into an example. You can see right here we have this 15-minute fair value gap at 5 in the morning of Friday of 6th of March. And then we got this pretty beautiful power 3 where you have, what is this? So you identify, all right, these are going to be two topics because I can't put them both in the same thing. So in this one, I'm going to be talking about how to use it and how to combine it with the Power 3, just because both of them are pretty straightforward and both of them combine pretty well. So you can see you got the Power 3 marked out right here by the accumulation, as you guys can see. And then you have, what is this above? This above, very well, is our manipulation. Now, how do I identify that the manipulation is valid? We identify if the manipulation is valid and if it actually is a real manipulation by just looking if it respects this, which is our entry level, which is the inversion fair value gap. We got it right here. And the change in the state of delivery, which we got right there. So this will be a pretty simple trade. This will be an entry for me. It follows the narrative as well because of what's happening, of the war and stuff. Everything's going bearish except oil. And yeah, now how do you mark the standard deviation? So as I mentioned, standard deviation stands for targets. But I can show you guys right here an example because you don't mark it like this. Remember, the example I'm going to give you, you don't mark it like this, okay? So you're going to enter, you set up the standard deviation like this. So you have your levels and you can see price touched the 0.62 right there. And then it went down. You can see pretty straightforward. And in this case, it did not touch my golden level by like a pip or so. It is what it is. It happens. But in this case, I will just be taking the entry otherwise. Now, how do you mark the standard deviation? To mark the standard deviation, you grab your fib tool with the fib settings that I told you, and you drag it. In this bearish example, you drag it from the highest point, basically the highest point of the manipulation, which is right here, to the lowest first pullback move of the expansion towards the manipulation. This may sound a little bit confusing, but I'm going to explain you again, right? So you got this expansion move that caused the accumulation and the manipulation, and you're going to grab the fib tool. You're going to place it at the high of the manipulation when it touched the fair value gap, the highest point of the manipulation. It has to be a wick, it can't be a body, and you just drag it down towards the lowest, towards the nearest pullback of the expansion towards the manipulation, which in that case, it would not be this one. You guys might have thought that this one is the pullback, but you guys can see that this minor setback, let's call, is a part of the accumulation. So everything that is inside of the accumulation cannot be called a pullback nor something else, right? That's why you got to watch my Power 3 video where I talked about how do you identify the real accumulations, because identifying the accumulation is actually one of the most important things, and one of the things that Power 3 traders actually fail the most is that identify the accumulation, right? Because you got all of these issues because people think this is a pullback, whereas this is just a manipulation. No, sorry, this is just the accumulation. So let's rewind. You have the highest pointed trading of the manipulation, which is this one. It has to be a wick. And then what is the pullback in this move? You see, you got this move, this expansion, and then accumulated and it manipulated. In here, the pullback is actually going to be this candle because, as the name suggests, it pulled back. So price was driving in this range, and that candle caused it to pull back and then align itself, right? Tap into a little bit of a discount so it could get cheaper, right? So that buyers could buy low and then sell high. Therefore, that pullback, which is also going to be a wick, is going to be our zero. So you guys understood? Highest point in a bearish example, highest point in trading during the manipulation, and the closest point of the pullback from this expanding range. If this is a bullish example, however, it is going to be the opposite. So you got this If it's a bullish example, it can also be like this. For example, if it's expanding and then manipulating. But if in a bullish example, it actually is a little bit different. And there are variations, and I'm going to show you guys right here. So in a bullish example, you have this, sorry, let me actually draw. You have this that causes the expansion, right? And then you got this, a little bit of accumulation, the manipulation, and then a distribution. Where would your standard deviation be? There you go. This is actually an exception of the rule, just because, as you guys can see, there is no real pullback. So what do you guys do? The lowest traded point of the manipulation, which is this wick, and the highest traded point of the accumulation, which is this. You can also have another thing, which is called sorry, I got a blank. Let me actually draw so you guys can see. Sorry, the start of the manipulation, the start of the rule manipulation, but that is really weird to talk about, which in this case, the start of the manipulations, in this example, the start of the accumulation, as you guys can, the start of the manipulation would actually be this thing right here, right? Would actually be this, because price was in a range before, and then once it broke out of this range, it actually started deviating, therefore going down, manipulating, causing that bottom tick and then expanding, and that is where you can put your standard deviation as well. There are a lot of exceptions to this rule, and I'm going to show you guys the exceptions, not in this video because this is just the basics. In a deep dive of the standard deviation, which is going to be another episode of my Trading Bootcamp, I will show you guys more explicitly the standard deviation, and that's why you need to learn this video beforehand so you guys can understand things properly and better, right? So now let's see, where would we enter after this change? So right there, sorry, wrong tool. This one right here. Stops would be at the manipulation high, or could be the body. And where would your targets be? So I usually like to target liquidity points, right? Which in this case, the liquidity points would be these two, right? But now with this standard deviation, and we actually had a lot of liquidity points below, just because the market was bullish and now what happened was bearish, I would be targeting the minus 0.2 or the minus 0.25. This is also a common traded range with the standard deviation, because price usually tends to distribute onto these levels and then reversing. That is usually what it does. So right, so price accumulates, manipulates, and then we can set up the standard deviation. And now I'm going to tell you guys about these levels. So you got here the -1. All of these levels are called pullback levels, because in these levels is where actually a lot of liquidity has been traded. It's levels that price is going to react off of it, and the -2 to minus 0.25 range are the strongest. Therefore, there should be your targets, but you can also target the -4. And I'm going to show you guys how strong these levels actually are, right? So mind me that there's a little bit of error, just because, I mean, not everything is to the dot, but if it's very close, you have to count it as real, just because this is also trading. There is human error, and then the actual producing of the candles. The candles can be produced like if you change, for example, mine is a thin capital. If you change for example, the SMC, the SMC group, I think, SMC, which SME, sorry. If you go change it to the SME, the candle production might be a little bit different, but it's basically everything the same except the candle. So if you're really close, you have to basically count it up as well. Yeah, it's called an error. It happens to everyone, and the candles as well. So you got the -1, -2, -2.5, and the -4. And you can see by yourselves, right there. Look, 0, it's also a level. Look what happened. Reacted right off, right? And now let's look. -1, what happened? Price started accumulating. So you can see the reaction off of these levels. These levels tell a lot, just because once price reaches one of these levels, you should be considering going break even straight away. Because this is one thing, since these levels are huge points that institutions and banks want to target, right? Therefore, you want to align with them. But sometimes these levels are so strong that they can actually inverse price and push price onto your stop loss in this example. Therefore, what I like to see is price usually accumulates or tends to have a little bit of resistance between these levels, especially the -1, as you guys can see it accumulated. And what I like to see is if the highest point in the -1, so when it touched was this right here, right? The highest point would be this. If we had a closure, so for example, a closure of this candle body, of this candle wick, if we had a closure with the candle body, this will be classified as a market structure shifts. And that will be enough for me to actually close my position in a little bit of profit, just because I would 199%, I was going to have 99% assurance that that point was going to have an inversion, and it was going to stop loss me out, to sweep me out, right? And now the -2 and -2.5, these are common areas, the range, you can target like this or like this. These also tend to have a little bit of resistance, not as much as the -1, but these are usually your targets. Therefore, you shouldn't be worrying about them, only if you are going into runners, which is basically the -4. But you can also see it caused a reaction from this when it touched, when it actually touched the -2, it reacted off, basically dealing that, right? And then this is your range, and the -4, I'm going to show you guys. Just look, I'm even going to put like this, just so you guys can see. Error, account for error, right? Because, I mean, it's like less than a point away, right? So account for error. I know for a fact that in SME this touched just because of the reaction. You guys can see the reaction of the -4, which is the last level of the standard deviation. What happened? Do I have to speak even more? This is how powerful it is. It accumulates in the -1. It either inverses or stays the same. If it stays the same, it's usually going to push into the -2 and the -2.5, which should be your main targets. And if you want to keep leaving runners so you can have a higher risk reward, it will be the -4. And the -4 only because once price actually touched the -4, it would inverse straight away, or it would create the most resistance that you would ever see. It's almost 3 times the resistance as the -1. You guys can check it out. You guys can backtest it. When price touches a -4 level of the standard deviation, it usually resists so hard that it can happen for hours. And I'm not even joking, because I had that experience while backtesting a lot of times. So, yeah, I spoke for about 23 minutes, and I think I already explained everything. Keep in mind that this is just an introduction video. I will show you guys a more deep dive of the video of the standard deviation, because this is such an important topic, such an important concept, that I will have to present another video for you guys, explaining explaining more in depth, explaining like the actual things that can differ from what I showed you guys right here. For example, when you can put on the body instead of the wick, that is an example, and all of the rules and tips and tricks that I will tell you, I would leave in the other video that I'm going to be making, which is a deep dive of the standard deviation. So yeah, if you guys enjoyed this introduction of the standard deviation, I would appreciate it if you guys subscribed, maybe like this video, comment on it, and yeah, I hope you guys enjoyed this video, and God bless.